Hello everyone, welcome back. Today we're going to talk about the tax benefits of self-employment. Okay, why you should be self-employed and get yourself self-employed as quickly as possible. Now, before we even talk about the tax benefits, let's just talk about the benefits period. Okay, it's important for you guys to understand that nobody hires anybody so that the person that they're hiring can become rich. Okay, when people hire somebody, they generally pay them as little as possible. Now, it doesn't make a difference. You might be hiring them for a high-level job. Like, you might be hiring an engineer. Right? Let's say you have an engineering company and you hire a bunch of engineers. Okay, you're still going to pay those engineers as little as possible relative to, let's say, what you were going to pay yourself. Okay, so so that's the idea. So it doesn't make a difference what level you're at, whether you're a doctor or a an accountant or a lawyer. If you're hiring these people to work for you, you're going to pay them less so that you can make a greater profit. So that's the first thing to put out there. So basically, if you are self-employed, obviously you're in a position to pay yourself more if your business is doing well. Okay? So let's put that aside, and now let's talk about the tax benefits. Okay. Now, the first thing I'm going to kind of put out there is that the government, does not want you self-employed. Okay, they don't want you self-employed. They want you working for some other corporation, preferably a large corporation. And I'll tell you why. Back when I started doing accounting back in the 90s, at that point, the Walmarts and the Lowe's and the chains hadn't completely taken over the United States. You still had a lot of, let's say, small hardware stores and small supermarkets that were, privately owned. And a lot of times when I would go in to do the accounting for these companies, right, I would go on site, and basically I would look at the payroll. The payroll showed basically that they had like 2 or 3 people working there, and then when I came in or when I left the store, I'd see that they had like 25 or 30 people working there. So it was obvious that most of those people were getting paid under the table. They were getting paid cash. And they weren't paying their taxes. Okay, so and it was a win-win situation for all. The employer didn't have to pay the payroll taxes, and the employer didn't have to pay their income taxes. So everybody was kind of benefiting from that, and that was kind of perpetuating itself. Okay, now when we have like Lowe's and Walmart and all these chains paying everybody, obviously these companies are not in a position to pay people under the table cash. So the government benefits because now everybody is basically getting a check with their income taxes taken out of that check, and then also the corporation, right, the chain, is also paying the employer taxes. Okay, so the government's actually doubling up on the taxes. So it's in the government's interest, okay, for everybody to be working for a chain, or a large corporation that doesn't deal with people on an individual basis. Because back, like I said, when I used to do like small hardware stores, there was this personal relationship that developed between the employer and the employees, and especially if somebody had been there for a year or 2 years. The employer would typically feel very comfortable in entering into a cash arrangement with somebody that they already knew for a year or two. Okay, so that's the reason why the government does not want you self-employed. Okay, now let's talk about the reason why you want to be self-employed, and let's just focus on the tax portion. Okay, if you're working for somebody and you're getting a paycheck, basically your employer reports to the government what your income is. Okay, when you are self-employed, okay, you get to report to the government what your income is. Okay, so that's obviously that kind of puts you in the driver's seat. Now there's now people will say, well, what if the government comes in and audits you and they found that you've been you haven't been paying your taxes and you've been underreporting your income? And no, we certainly don't want to run that risk, okay? But here's the thing. When you're running a business, even a small business, even a small mom and pop shop, right? Let's say you have a small deli, okay? It's very typical for a deli to do, let's say, gross. And when I say gross, top line, the money coming into the register. It's very typical for a deli to, let's say, do $1 million in a year, okay? Now, out of that $1 million, of course, they got to pay their expenses. they got to pay, their rent, they got to pay their electricity, their utilities, the payroll, and of course the supplies, all the stuff that they buy. Okay, so even if you're making $1 million gross, okay, when all your expenses are calculated, your expenses, let's say, are going to total $900,000, $950,000. So the point is that you gotta do like $1 million gross so that you can make a profit of $100,000. Okay, and here's the thing: that profit, that $100,000 profit on $1 million gross, is a pretty small number. It's a small number, and when you have a number that's that small, the profit's always going to be a small number relative to the gross number that you're bringing in. When you have a number that small, basically, a gentle wind can blow it left or right, up or down. Okay, there's a lot of things that can happen to affect that number. Now, if you are a service business, just to give you an example, right? If you're a service business and you don't maintain inventories, you're able to use what they call a cash basis. Okay, what that means is that when the money comes in, that's revenue, and when you pay out the money, that's expenses. All right, and basically you're working straight off your bank statement. Basically all the deposits are income, all the expenses are all the money going out, all the payouts are expenses. But and it's pretty straightforward. Okay, so in a situation like that, well, if I want to increase my expenses, right? Let's say I'm in December now, and I'm keeping track, and I see that, holy shit, it looks like I'm showing $100,000, close to $100,000 in profit. Well, how about I prepay my 2 months rent in advance, right? And how about I buy some more supplies? I'll stock up on some supplies. So the point is that at the end of the year, I can prepay a lot of expenses. Okay, or if I'm a service company, what I can do is I can, if it's, let's say, the last week in December, I could tell my customer, you know what, instead of paying me this week, pay me next week or 2 weeks from now. Okay, so this way the money goes, the revenues go into the following year. Okay, so I can increase my expenses that way and decrease my revenues that way. So there's an easy way to manipulate your bottom line if you're a service business, right? If you're providing services like grass cutting or computer, so you do computer programming or anything that doesn't maintain, where you don't have inventories. Okay. So again, on a, if your top line's $1 million and your profit's only $100,000, which is pretty typical, $100,000 is a nice, is a nice salary, but you can manipulate that, just by playing around with the, when the money comes in and when the money goes out at the end of the year, last week of the year, for that matter. Now, let's say you are a company that holds inventory, right? Let's say you're buying and selling inventories. Okay. Well, there's similar things that can be done. For example, with your inventory, what typically happens is at the end of the year, you have to take an inventory, because the way it works with an inventory-based business, right? You have your sales, right? That's your top line, all right, and then you have your cost of sales, right? Cost of goods sold, and the way that's calculated is basically you take your inventory at the beginning of the year, you add your purchases, and then you subtract the inventory at the end of the year to come up with your cost of sales. Okay. So it's a calculated number, so it's not just the purchases that you're looking at, but you're also looking at your beginning inventory and your ending inventory. Okay, and here's the bottom line: unless the government is there to watch you count that inventory on the last day of the year, they have no way of going back in time and saying that the inventory number you presented is incorrect. Okay, now the other thing with an inventory-based business is that when you, let's say, if you bill something out, okay, it's not considered a sale until the item ships. Okay, so there's another way that you can play around with your sales, basically by choosing not to ship some things at the end of the year. Okay, because then basically even if you have the money, it becomes basically a deferred sales account. It becomes a deferred sale. So basically, you would temporarily remove that numbers from your sales figure. Okay, so right there, I'm just giving you guys an example, and these are you know, again, this is playing within the rules, right? These are part of the rules. I'm not necessarily cheating here, but I'm basically I'm working within the rules to get the numbers that I want. Okay, and you know, I'm not gonna, there's a lot more stuff beyond this, but I don't want to, you know, that's stuff that I would tell people face to face or in person. You know, and a lot of the times it's specific to their situation, how they run the company. But I just explained to you like a few obvious ways that the you know, that the sales number, that the profit can change. Okay, so on a company, on a small company, on a tiny company that grosses $1 million per year, right, and typically has expenses of about $900,000. Okay, a profit of $100,000 is a small number that can blow. You know, you can easily get that number to blow up $100,000 or down $100,000 with some planning. Okay, and there's nothing illegal with planning. Okay, I can, you know, it's like, you know, I can decide whether I want to buy something this week, or if I'm going to buy it next week, or if I'm going to ship something this week or ship it next week. You know, that's all perfectly legal. I'm in a position to decide when I buy things, when I don't buy things, when I ship things. So I just wanted to illustrate to you guys the benefit of being self-employed. You get to make decisions. You know, you get to look at the rule book and you say, oh, okay, these are the rules. All right, great. How am I going to make these rules work for me and not break the rules? You know, you know, like I said, I definitely recommend everybody get into the path of becoming self-employed. Now, the way I say, don't rush into it. What you want to do is, you know, when you in your early years, right, when you're in your 20s, it's good to work for somebody so that you can gain experience from them, learn from them, learn how to do a particular business, learn how to provide particular services. Okay, and yes, they are taking advantage of you in the sense that they are underpaying you, and in return, you should be taking advantage of them to the extent that you are basically, you know, learning how they operate. You know, you're basically collecting information so that later on you can have your own business. You know, you can start your own business. So don't rush to go from working for somebody to trying to make your own business, because it's pretty easy to fail. Build up experience. And basically in your early years, it's you know, a lot of times you get different employment opportunities. You know, don't always take the job that pays the most. Take the job that is where you're going to develop skills that you can turn around and sell for yourself, you know, in the future. All right. So there's a few ideas for you guys to think about. You know, post some comments if you haven't. Talk to you guys next time.